Hello and welcome to another financial analysis video. Today I'm going to talk about Gamestop, and this share price data is as of the close of the market on Tuesday, March 28th. However, I want to talk more broadly about the quarterly statistics with Gamestop and why after the earnings came out and the shares sold off, I went ahead and picked up some shares. So obviously, as a disclosure here, I own shares of Gamestop. The news of the earnings release last week really sent shudders through the investors' minds, and as a result, they sold off some shares of the stock. And this is becoming more common in retail as the bricks and mortar retail stores struggle to appease investors. There's a lot of fear out there that Amazon and Walmart's e-commerce are going to wipe everybody out. So, you know, any type of bad news in retail, you're going to see these drops. And it looks as if GameStop has had bad news delivered before. Some big moves across the board in this stock. And I've owned it on a number of different occasions and let it go. I've not, unfortunately, I've not held the stock for more than 6 months because even though it's got income with the dividend yield, it pops up into areas that I'm feeling more comfortable selling than holding on to the stock. So with GameStop, I really want to focus on this dividend and the yield now approaching or exceeding 7%, which would grab any income investor's attention. Typically, with stocks like these, I look at a couple of factors. I look at the payout ratio and I look at free cash flow to make sure that the company is able to pay that dividend. So I want to start with, I actually want to look at earnings first because the earnings for the company are important to me. If the company shows that it can meet or beat earnings expectations, and it has for 5 consecutive quarters, that to me gives me some comfort when I look at forward earnings to know that the company going forward is going to be able to meet or beat those earnings expectations. And I have that here in an earnings grid, as I like to call it. And over time, you could see that analysts have become a little more pessimistic as to the outlook of GameStop's earnings. And really, because of the seasonality of this stock, we have to focus on that fourth quarter. And going forward in 2018, we're seeing these fourth quarter earnings expected to be $2.34, much lower than $2.79, which was expected a little more than a year ago for that same quarter. But while this is a little more pessimistic, I want to take a view down to the payout ratio. So this is the future payout ratio, and I apologize, it's a quarterly payout ratio versus an annualized one. But you could see that these big quarters that lead the company still provide decent payout ratios. And another way to take a look at it is we'll look at, we'll do a calculation here on our own. We'll go into our dividend for quarter dividend component, and that is right here, 38 cents over the next 12 months. I have another table that I like to look at as well. It's not over the next 12 months. It's $1.52 over the next 12 months. So that right now is the current dividend, and that is very recent. That's as of a few weeks ago for shareholders of record. So $1.52 over the next 12 months. Our forward earnings for 2018 are $3.72. So that's a payout ratio of 41%. So clearly the company is still able to meet that dividend obligation based on earnings. Another way to look at it, and I have that table right here, is the payout ratio on a trailing 12-month basis. So there's the 100%. If earnings go over that, you're in trouble. Right now we're at 39% on a trailing 12-month basis, which isn't bad. 39 cents of every dollar earned is going towards dividends. It should go to 41 cents on the dollar in 2018. So I'm not really concerned from an earnings standpoint about the dividend. The other one I want to look at is free cash flow on a trailing 12-month basis. The blue line represents free cash flow on a trailing 12-month basis. The red line is representative of the dividend obligation over the next 12 months as estimated by taking number of shares, etc. We had that dip in Q2 of 2017, and I actually wrote an article about that in which I said I'm a little concerned about this, and investors need to watch that to make sure further degeneration of free cash flow doesn't occur. Yet the company has bounced right back in the last 2 quarters and generated plenty of free cash flow to handle that. Let's insert in here a trend line. I want to look at a trend line over the last 4 quarters. So a 4-quarter moving average of this, because we're seeing a lot of volatility here in this free cash flow, even though it's taking a 4-quarter perspective. So we do still see, when we take a moving average in, some drop in free cash flow, and these next couple of quarters are going to be critical because those are the weaker quarters for GameStop. So we'll want to see free cash flow continuing to stay above that $150 million mark on a 12-month basis. And if it does, as far as I'm concerned, this 7% yield is sustainable. It's worth the risk. I'm a younger investor. I can handle these types of losses, but I would say even for older investors looking for income, they ought to consider this. It's not a bad bet to take. Again, though, if shares were to all of a sudden rebound back up into the low 30s for any number of reasons, I would consider taking my gains and getting out, because this stock is susceptible to dipping on bad news. I think it's harder for it to dip below $20 a share on bad news as opposed to being at 30 and then dipping down to 25. So right now I'm a buyer of GameStop. I hope obviously that the free cash flow continues in order to support the dividend. I hope you enjoyed this video. We'll see you next time.